Stop saving money. That sounds irresponsible, doesn't it? It sounds like something you would hear from someone trying to sell you a shortcut, a risky investment, or a secret strategy that promises freedom without discipline. But here's the uncomfortable truth. If all you're doing is saving money and nothing else, you are quietly falling behind. Inflation does not care how disciplined you are. Rising costs do not reward your restraint. And simply stacking cash in a bank account without a system behind it is not a long-term wealth strategy. If you want calm, realistic financial education that challenges old assumptions without hype or get-rich-quick nonsense, make sure you like this video, subscribe to the channel, and comment below how much you currently rely on saving versus investing, because this shift in thinking might completely change your approach. Now let's clarify something immediately. I'm not telling you to stop being responsible. I'm not telling you to stop building an emergency fund. I'm not telling you to ignore risk. What I am saying is that the traditional advice of just save more money is incomplete. It was built for a different economic era, when interest rates were higher, housing was cheaper relative to income, and long-term growth felt more stable. Today, the rules are different, and if you're still playing by the old ones, you may be working hard but not moving forward. Here's the mindset shift you need to make. Saving is defensive, investing is productive. Saving protects you, investing grows you. Both are necessary, but they are not equal in long-term impact. Many beginners confuse safety with progress. They believe that if their bank balance is growing, they are building wealth. But here's what most people misunderstand. Wealth is not measured by how much cash you hold. It's measured by how many productive assets you own. When your money sits in a standard savings account earning minimal interest, it slowly loses purchasing power over time. Even modest inflation quietly erodes its value. You might feel secure watching the number rise, but if that money isn't working for you, you are standing still in a world that keeps moving forward. This is where beginners go wrong. They focus entirely on accumulation and ignore growth. Let's break down the core concept clearly and simply. Saving money is about liquidity and stability. It ensures you can handle emergencies, unexpected expenses, and short-term needs without debt. That is essential. But once you've built a solid emergency cushion, continuing to prioritize saving over investing creates opportunity cost. Opportunity cost is the hidden price you pay for choosing one option over another. In this case, the cost is long-term compounding. Compounding is the engine of wealth. It is the process where your money earns returns, and those returns begin earning returns of their own. But compounding requires time and exposure to productive assets like businesses, broad index funds, or income-generating investments. It cannot function effectively if your capital never leaves a low-yield account. Now pay attention to this part, because this is where the real shift happens. The goal is not to maximize how much you save. The goal is to maximize how much of your income flows into assets that grow. One of the biggest mistakes people make is over-prioritizing visible security while under-prioritizing invisible growth. They keep adding to savings long after they have enough liquidity. They delay investing because they don't feel ready. They wait for a perfect time, a bigger income, or a clearer economic outlook. But perfection never arrives. And time, the most powerful ingredient in compounding, quietly slips away. Another common mistake is confusing frugality with strategy. Cutting expenses is helpful, especially in the early stages of financial independence. But cutting alone cannot create wealth. You can only reduce expenses so much. Income growth and asset growth are what expand your financial life. Saving is about shrinking spending. Investing is about expanding capacity. And long-term wealth requires expansion. So what is the new rule of finance? The new rule is simple. Save with a purpose, invest with a system. Your savings account should serve a specific function: emergency protection and short-term goals. Once that function is fulfilled, your priority shifts toward directing excess cash into productive assets consistently and automatically. Let's talk about a practical framework you can apply immediately. First, build a clear emergency fund that covers several months of essential expenses. This protects you from high-interest debt and financial panic. Second, automate your investing so that a portion of every paycheck flows directly into long-term investments before you have the chance to spend it. Automation removes emotion. It turns investing from a decision into a habit. Third, increase your investment rate as your income rises. This is where many people stall. Their income grows, but their lifestyle expands at the same pace. The new rule says income increases should strengthen your asset base first, not just your lifestyle. Fourth, periodically review your asset allocation to ensure it aligns with your long-term goals and risk tolerance. This doesn't require constant trading or predictions. It requires discipline and clarity. Here's what most people misunderstand again. Investing does not mean gambling. It does not mean chasing trends, timing markets, or speculating on headlines. Long-term investing is about owning productive assets consistently, reinvesting earnings, and allowing time to compound growth. It is slow, it is sometimes boring, it is occasionally uncomfortable, but it works when done with discipline. Emotional discipline plays a huge role in this transition. When markets decline, your instinct may be to retreat to cash because it feels safe. When headlines are negative, holding investments feels risky, but safety and comfort are not always aligned with growth. True financial maturity is learning to tolerate short-term fluctuations for long-term gain, while maintaining a safety net that prevents catastrophic mistakes. Another psychological trap is the illusion of progress. Watching a savings account grow feels satisfying because the number never goes down. Investments, on the other hand, fluctuate. That fluctuation can create anxiety, even if the long-term trend is upward. This is where emotional control separates wealth builders from savers. Wealth builders understand that volatility is the price of long-term returns. Now, consider scalability. There is a ceiling to how much saving alone can do for you. If your strategy is purely to accumulate cash, you are limited by your income and discipline. But when you invest in productive assets, you introduce scalability. Your money begins contributing to your growth. It is no longer dependent solely on your labor. Over time, this shift from labor-based growth to asset-based growth changes your financial trajectory entirely. And here's an additional layer that many people overlook. Inflation doesn't just reduce purchasing power, it raises the cost of future goals. The house you want to buy, the retirement lifestyle you imagine, the education you plan to fund, all become more expensive over time. If your money is not growing at a rate that outpaces rising costs, you are forced to either delay those goals or lower your expectations. This silent pressure is why relying only on saving creates long-term frustration. Investing, when done responsibly and consistently, is what allows your future purchasing power to expand instead of shrink. It gives your money a job beyond sitting still. It aligns your present discipline with your future freedom. This does not mean abandoning caution. It means structuring your caution intelligently. Keep cash for protection. Deploy capital for growth. Separate your emergency reserves from your long-term investment accounts mentally and physically. This separation reduces the temptation to retreat from investments during normal volatility. And here is the deeper lesson. Financial independence is not achieved by hoarding money. It is achieved by owning systems that generate value over time. Savings provide stability. Investments provide freedom. Both are necessary, but one builds the foundation while the other builds the structure. So let's recap clearly and calmly. Stop saving money as your primary strategy. Start saving with intention and investing with consistency. Build an emergency fund that protects you from short-term shocks. Then, channel your energy toward accumulating productive assets that compound over years and decades. Avoid hype. Avoid shortcuts. Avoid speculation. Focus on systems, discipline, and time. If this perspective challenged the way you think about money, like the video, subscribe for more realistic and system-focused financial education, and comment below whether you've been over-prioritizing saving instead of investing. And if you want to understand how to build those systems properly, you should watch the video called How to Build Wealth from a Normal Salary, because earning more matters, but directing it correctly matters even more.